What does the Fed's latest approval actually mean for markets and your money? And why should a decision about a savings and credit cooperative be on your radar today? Here's the context. The Federal Reserve Board approved an application from Cooperativa de Ahorro y Credito Elga, Ltda. It's a regulatory milestone that doesn't change interest rates, but it reinforces the rules and oversight that keep the financial system stable. In a market focused on inflation, policy rates, and lending conditions, these quiet approvals shape the backdrop that credit and funding depend on. So, what does this signal? First, the applicant met U.S. supervisory standards. That usually means strong capital, credible risk management, and compliance programs that address anti-money laundering and consumer obligations. It also suggests governance and management pass scrutiny for experience and control. Second, approvals like this often cover specific activities. That can include opening offices, engaging in defined lending or financing lines, or forming affiliations that meet statutory limits. The details weren't released, but the process is known for rigor. The Fed typically reviews competitive effects, market concentration, and safety and soundness implications before it says yes. Third, there is a cross-border dimension. When a cooperative with international ties interfaces with U.S. rules, the Fed looks for alignment with domestic safeguards. That helps ensure that new or expanded activities do not add hidden risks to funding markets or consumer outcomes. Why does it matter now? Because credit conditions are a live driver of growth, and regulatory discipline supports resilience. Approvals that uphold prudential standards help keep credit flowing while protecting depositors and borrowers. They also provide a signal to other institutions about the bar they must clear to expand. What should investors and customers watch next? Monitor whether the cooperative announces new services, geographies, or partnerships following the approval. Look for disclosures on capital, risk controls, and governance in any follow-up materials. Track how competitive dynamics shift in the relevant lending niches, and watch broader indicators like lending spreads, funding costs, and bank credit surveys to see if regulatory clarity supports steadier credit availability. Your practical takeaway: not every Fed decision moves rates, but many build the scaffolding that markets stand on. Stay alert to regulatory actions. They can foreshadow where credit capacity grows, which players gain share, and how risks are being managed behind the scenes. Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.